Welcome to our journey through finance, navigating the labyrinth of bank loans. Imagine a world where money talks, and its voice is a symphony of interest rates, collateral, and carefully crafted agreements. This is the world of bank loans, where borrowers and lenders engage in a delicate dance of negotiation, seeking to strike a balance between risk and reward. Our story begins with a simple question: to borrow or not to borrow. This story delves into the advantages and disadvantages of seeking a bank loan, from the convenience of readily available information to the potential for lower interest rates and banks offer attempting a loan. On the other hand, they can be demanding with collateral, reluctant to lend long term, and prone to personal turnover. The story then guides us through the labyrinth of loan criteria, revealing the factors that banks consider when evaluating loan applications. First, the bank-applicant relationship. It plays a key role in determining the outcome of the application, as banks may take into account factors beyond the application itself, such as the trustworthiness or reputation of the applicant. Second is the managerial ability. They will often look at the managerial ability of the person or business applying for the loan. This means that the bank will assess the competence and commitment of the borrower in terms of their ability to pay back the loan. Some factors that a bank may consider include the borrower's track record in managing finances, their experience in their industry, and their long-term plans for the business or project for which the loan is being requested. Third is the references. It is an important part of the loan application process, as they provide the bank with additional information about the applicant beyond what is included in the application itself. It is typically individuals who have worked with the applicant in a professional capacity, such as security or collateral. When a bank is considering a loan application, they will often ask for the borrower to provide some form of security or collateral as a way to reduce the risk to the bank and ensure that the loan is repaid. This can take the form of assets such as property, vehicles, or equipment that can be used to cover the cost of the loan if the borrower is unable to pay it back. When a bank is considering a loan application, one of the key factors they will look at is the applicant's net worth and financial stability. This is called capital, and it refers to the total value of the assets and resources that the applicant has available to them. Banks may use this information to assess the applicant's ability to repay the loan, as well as to determine how much they are able to borrow. The higher the applicant's net worth, the more likely the bank is to be willing to lend to them, and the larger the loan they may approve for. Next is the cash flow. This refers to the amount of money that the business is able to generate from its operations after accounting for expenses and taxes. Banks will typically look at the business's income statements, balance sheets, and cash flow statements to assess the company's ability to generate enough cash flow to repay the loan. They may also look at factors such as the business industry and market position to get a better understanding of its ability to generate income and pay the loan back. Credit history. This refers to the applicant's track record of borrowing money and repaying loans on time. A positive credit history marked by responsible borrowing and timely repayment can increase the chances of a loan being approved, as it shows that the applicant is a trustworthy borrower. And lastly is the economic conditions. Its interest rates, inflation, and GDP growth can all impact a bank's willingness to lend. Banks may also look at industry trends and current market conditions to determine how well the applicant's business or industry is likely to perform. If conditions are poor, the bank may be less likely to lend money, as they may believe it will be difficult for the applicant to repay the loan.
The story further highlights the red flags that can lead to loan disapproval, such as missed payments, shrinking bank balances, and reluctance to cooperate with bank officials. It also compares the requirements of commercial banks, identification, employments, financial statements, collateral, credit history, business viability, operational history, legal compliance, tax returns, and accounting records. Finance company, business registrations and permits, identifications, bank statements, DTI, financial projections, financial statements, NBI clearance, and loan application form, and executives of the finance companies revealing the nuances of each institution's approach to lending. Also, the bank emphasizes the importance of a comprehensive financing package that provides a clear picture of the business, ownership, and market. Let me delve us deeper to the section 1 of the financing package. The first hurdle was understanding what banks look for in a business owner. The banks prioritize management experience, especially for new businesses, viewing it as a key indicator of success, while factoring like residence, education, and even health might seem irrelevant, they subtly influence a banker's perception. The banks also wanted concrete evidence of relevant work history, whether through previous job certifications or even owning a similar business. This wasn't just about showing skills, it was about proving their commitment to the journey. They came to the crucial question of business objectives. Short-term goals wouldn't impress the bank. They needed to articulate a long-term vision, a plan to build a competitive business, gain market share, and become a major force in the industry. Finally, the financial status came to play. The bank wanted to see a substantial personal investment in the business, demonstrating a genuine stake in its success. A high level of personal commitment indicated a lower risk of abandoning the venture during the tough times. And lastly, as we go to the section 2, where we take the first step was crafting the company history. We meticulously detailed the ownership structure, highlighting any changes in company name, relationships, or owner percentage. They also transparently listed any outstanding debts to banks or individuals. Next came the product service section. This wasn't about technical specifications, it was about showcasing the product's unique value propositions. It focused on why their product or service was superior, providing market statistics to demonstrate demand. The market competition analysis was equally crucial, where they meticulously researched the market size, growth potential, and their company's market share. Finally, the financial section was paramount. This is where the meticulous record keeping paid off. They presented audited financial statements for the past 3 years, or year to date for a startup. Along with the projected tax return, most importantly, they provided projected financial statements including the project balance sheet, income statement, and cash flow statement. This demonstrated the company's ability to generate sufficient cash to repay the loan. This story sheds light on the intricacies of bank loans, the importance of a solid financial foundation that empowers readers to make informed financial decisions. Whether they're aspiring entrepreneurs, seasoned investors, or simply looking to manage their finances effectively.